Okay, let's unpack this. Nebius Group. Picture this. Their stock price rockets to over $50 back in February 2025.
Yeah, and we're seeing that.
And then bam, it drops by more than half. So what's really going on with this company? You know, the one that spun out of Yandex to focus on AI infrastructure, quite the ride.
It really is. And that kind of volatility, well, it tells you something right away. The market sees massive potential, sure, but also like significant uncertainty.
Exactly. Which is why we're diving deep today. We've got this really detailed analysis of Nebius Group NV, that's NBIS, on the NASDAQ from April 28th, 2025.
Right. Fairly recent data then.
Yeah, and our goal is pretty simple. Get a handle on what this company actually is, its potential in this huge AI infrastructure market, and, you know, the key questions you should be asking.
So sort of cutting through the noise.
Precisely. Think of it as your fast track to getting up to speed, getting the core takeaways, the surprising bits maybe.
And it makes sense. AI is just demanding so much compute power, and Nebius is trying to plant itself right in the middle of that demand curve. That explains some of the hype and maybe some of the fear, too.
Absolutely. So here's the plan. We'll break it down into 7 parts. First up, business understanding. What do they do?
The fundamentals.
Then, management evaluation, who's in charge. After that, we hit the financial health, numbers time.
Okay.
Then in the second half, we'll gauge market sentiment, look at the ownership structure, who actually owns this thing, and then a SWOT analysis. Strengths, weaknesses, you know the drill.
Risks and opportunities. Crucial.
And finally, we'll wrap it with some conclusions and maybe a little something to chew on. Sound good?
This is like a solid plan. Let's do it.
All right, Chapter 1. Business understanding. So where did Nebius even come from? Seems like they appeared quite suddenly.
Well, their origin story is directly tied to geopolitics, really. Nebius Group officially emerged in July 2024. It happened because Yandex NV had to divest to sell off its non-Russian assets. This was all fallout from the Russia-Ukraine conflict and the sanctions that followed.
So they took the international parts and rebranded.
Exactly. Rebranded and refocused everything squarely on AI infrastructure.
But it wasn't a totally new team, right? I saw Arkady Veloz, the Yandex co-founder, is still heading it up.
That's right, and that's a key point. Veloz led Yandex for 25 years, built it into a $30 billion company at its peak. His presence provides continuity, technical depth.
Okay, so experienced leadership, a clear focus. What is this core Nebius AI offering then?
Nebius AI is the absolute core now. Think of them as a specialized cloud provider, but like laser-focused on AI.
Infrastructure as a service.
Primarily AES, yes. Renting out compute power, essentially. And maybe some PODOs, platform as a service, down the line. Revenue comes from usage, how much compute, especially those high-demand GPUs, storage, data transfer you use.
And who are they targeting?
Everyone from AI startups needing resources to big corporations with huge AI projects.
Got it. So tailored for AI, not just general cloud stuff. What specific products make up this full-stack AI infrastructure solution they talk about?
Yeah, full stack is important here. It's not just raw compute. It includes these massive GPU clusters.
The NVIDIA ones.
Exactly. Cutting-edge NVIDIA hardware, H100s, H200s. And what's really interesting is they're positioning themselves as an early adopter for the next-gen NVIDIA Blackwell Ultra chips.
That suggests a close relationship with NVIDIA.
It does. Plus, they have their own AI-centric cloud platform. That's their proprietary software, built specifically for the demands of AI, machine learning, large language models, all that heavy stuff.
And I saw something about making AI models easier to use. Nebius AI Studio.
Right, their inference as a service. Basically, you can run Access to run popular open-source AI models, think Llama 3.1, the Mistral models, without needing your own massive hardware setup.
How do they charge for that?
It's cost-effective per token pricing, so you pay for what you actually process. Lowers the barrier to entry quite a bit for developers and researchers.
Seems smart. Okay, where are they actually building all this infrastructure? Is it global?
Oh yeah, very global and very aggressive expansion.
Yeah.
Their big European hub is in Finland, Mäntsälä. They're tripling capacity there to 75 megawatts.
Wow. How many GPUs is that?
Potentially 60,000 GPUs. That one site could bring in over $1 billion a year if it's fully utilized.
Huge potential just there. What else?
They got a GPU cluster in Paris, inside an Equinix facility, running H100 SH200s now, planning for Blackwell there too.
Okay, Europe covered. What about the U.S. market?
Big push into the U.S. They have a partnership in Kansas City, Missouri, that's with a company called Patmos. Should be online Q2 2025, starting with H200s, but potential for maybe 35,000 GPUs there.
And wasn't there another U.S. site?
Yes, a brand new build in Vineland, New Jersey. That one's massive, up to 300 megawatts potential, dedicated specifically to Blackwell. Phase 1 is supposed to launch summer 2025.
300 megawatts. That's enormous. Any other locations?
Iceland. A new facility in Keflavik tapping into geothermal power. Expected Q1 2025.
So Finland, France, Kansas City, New Jersey, Iceland. That's a lot of building happening very fast. What's the overall scale they're shooting for?
The targets are aggressive. Over 22,000 Blackwell GPUs just in the U.S. and Finland this year alone.
Okay.
They've secured expansion plans for over 400 megawatts total capacity, with a medium-term goal of over 250 megawatts operational, though that depends on financing, of course.
And the money.
They've committed over $1 billion for the European build-out by mid-2025, and just recently secured another $700 million in funding.
So boiling it down, their value proposition is high-performance, AI-specific infrastructure, possibly cheaper than the big guys, leveraging their own tech and that NVIDIA connection.
That's the core idea, yes. Specialization is a competitive edge.
No, it's Nebius Group. So Nebius AI isn't the whole story, right? There were other subsidiaries mentioned.
Correct. Remnants from the Yandex International Assets. There's Toloka AI. They do data services for AI, like collection, annotation, projecting maybe $50–70 million revenue this year.
Oh.
Triple 10. That's an ed tech platform focused on tech reskilling, strong in the U.S. and Latin America, aiming for $40–60 million revenue in 2025.
Right.
Then Avreed. That's their self-driving tech unit passenger cars delivery robots. They have partnerships with Uber and Grubhub for campus deliveries.
Autonomous driving, that sounds expensive.
Very capital intensive. Needs around $150 million just for 2024-2025. They hoped for initial revenue late last year, targeting contribution profit break even by the end of this year, 2025.
Ambitious. Anything else?
They also hold about a 28% stake in ClickHouse, the open source database company. That was valued around $2 billion.
So a few other pieces, but Nebius AI is clearly the main engine for growth here.
Absolutely. The subsidiaries contribute, but the investment, the focus, the big revenue targets, it's all centered on Nebius AI. Their projected revenues are pretty small compared to the AI infrastructure ambitions.
Okay, Chapter 1, done. Makes sense. Let's move to Chapter 2, management evaluation. Who's steering the ship? We mentioned Veloz.
Right. Leadership is critical, especially in a pivot like this. Veloz, co-founder of Yandex, 25 years at the helm, took it to a $30 billion plus market cap. That's a serious tech and business track record.
Can't argue with that experience. What about the rest of the team?
The analysis suggests a broad team with deep experience in relevant areas: IT infrastructure, AI, data science, even the edtech and autonomous vehicle fields from the subsidiaries. Many seem to have come over from Yandex, so they likely know how to work together.
And how did they handle that incredibly complex Yandex split? That must have been a nightmare.
Well, successfully navigating that divestiture under intense geopolitical pressure, separating the assets, and then getting Nebius relisted on NASDAQ, it definitely shows strategic thinking and operational capability under fire.
There was also the issue of EU sanctions on Veloz personally, wasn't there?
Yes, there was. But those sanctions were later lifted. And importantly, Veloz publicly condemned the war. That's part of the narrative now.
Okay. How are they doing on transparency and communication as a public company now?
They seem to be ticking the standard boxes. Investor relations website, press releases, earnings calls, SEC filings, Form 6K for foreign issuers, investor presentations. Looks like they were adhering to typical public company practices.
And ethically, given the Yandex history and the sanctions episode.
The analysis acknowledges that history, but points to the deliberate steps taken. The full divestment from Russia, Veloz's public stance, the lifting of sanctions, and establishing Nebius as a European entity based in the Netherlands operating under international rules. They're clearly working to build that reputation as a separate, Western-focused company.
Okay, now, this dual-class share structure, this caught my eye. Can you break that down? It sounds important.
It is very important for understanding control. They have Class A shares, the ones publicly traded with 1 vote each.
Standard.
But then there are Class B shares held entirely by the Lastar Trust, which is controlled by Arkady Veloz. And these Class B shares get 10 votes each.
10 votes. Wow. So what does that mean in practice?
It means that while the trust holds only about 13.1% of the economic interest, the actual ownership stake, it controls roughly 55.3% of the total voting power.
So Veloz effectively has majority control, regardless of how many Class A shares are out there.
Precisely. The trust has the final say on major decisions, electing directors, approving mergers, stuff like that. It concentrates power significantly.
That kind of structure often raises flags for corporate governance folks, right?
It does. While proponents argue it allows for long-term vision without being buffeted by short-term market whims, critics say it insulates management from shareholder accountability. It disenfranchises the Class A shareholders to a large degree. It's common in founder-led tech, but definitely a factor for investors to weigh.
Good to know. Okay, what about capital allocation? Where are they putting their money?
It's crystal clear, pouring money into Nebius AI infrastructure. They spent a whopping $808 million on CapEx in 2024.
$808 million.
Yeah, and almost half of that, $417 million, was just in Q4. It's all going into data centers, GPUs. That plan for over $1 billion in Europe by mid-2025, plus the recent $700 million funding, including from NVIDIA, it's all fueling this massive build-out.
So growth, growth, growth. No dividends, no share buybacks then.
Not happening now. Totally typical for a company in this hyper-growth phase. Reinvesting everything is the priority. The analysis notes their return on invested capital, ROIC, is negative right now, which you'd expect, not a useful metric yet.
Okay, that gives us a good picture of the management and their strategy. Let's pivot to Chapter 3, financial health. Time for the numbers.
All right, as of late April 2025, the market cap was around $5.63 billion. Share price about 23.88, metal roughly 236 million shares out there.
And the all-important PE ratio, are they profitable?
Nope, not applicable. They had a significant net loss in 2024, about $347 million. You need positive earnings for a PE.
Right, makes sense for this stage. But revenue growth, that must be the key story.
Growth has been impressive, but with a caveat.
Yeah.
Full year 2024 revenue was $175 million. Q4 2024 revenue hit $62.5 million. That's a huge 220% jump compared to Q4 2023. Year over year, fantastic.
But what's the caveat?
The sequential growth, Q4 versus Q3 2024, was only 13%. Still growth, but a noticeable slowdown from that explosive pace. Might suggest some growing pains or market fluctuations.
Interesting. How did that Q4 revenue break down?
Nebius AI itself brought in $17 million in Q4. The subsidiaries added Toloka, $19.1 million, Triple Ten, $16.6 million, and Avride, $9.8 million.
And their forecast for 2025?
Guidance is for $340 million to $420 million for the full year. Still massive year-over-year growth, 94% to 140% at the midpoint.
So huge growth expected to continue despite that sequential blip. What about margins? Still deep in the red?
Yes. For 2024, margins were very negative. They didn't report a consolidated gross margin. Adjusted EBITDA was a loss of $225 million. Net loss, as I said, $347 million. So net margin deeply negative.
But they expect improvement.
They're guiding towards hitting adjusted EBITDA break-even at some point during 2025. But they still expect a net loss for the full year. So progress, but profitability is still a ways off.
Okay. What about debt? Companies investing this heavily often take on a lot of debt.
Surprisingly, zero financial debt on the books as of end of 2024.
Really? Zero?
Zero financial debt. They do have significant lease obligations, mostly for data centers, about $526 million. But their total equity is pretty solid, around $2.3 billion. So no traditional debt burden, which is a strength.
That $700 million funding round probably helped there too. What about cash flow? Are they burning through cash?
Oh, definitely. Cash flow from operations in 2024 was negative $182 million. Add that massive CapEx spend of $808 million.
It means huge negative free cash flow.
Exactly. They're funding operations and all that investment from their cash reserves, burning cash rapidly to grow rapidly.
Okay, so spending big, but financed through equity and cash, not debt. What about valuation metrics like price to book or price to sales?
Price to book is around 2.4 times. Not crazy, but price to sales.
Yeah.
That's where it gets eye-watering.
How high?
Based on 2024 revenue, the trailing PS is about 32 times.
32. Wow.
And even using the midpoint of their 2025 guidance, the forward PS is still around 15 times. Very, very high. It tells you the market is baking in enormous future growth and eventual profitability.
So wrapping up financials, strong balance sheet, no debt, but burning cash, unprofitable currently, and trading at very high sales multiples. High hopes priced in.
That sums it up perfectly. Financial stability comes from the cash, but the valuation is all about future execution. It's a speculative growth play right now.
All right, fascinating picture so far. We'll take a quick break, and when we come back, we'll look at market sentiment, ownership, and the risks and opportunities. Stay with us.
Welcome back. We're deep diving into Nebius Group, ticker NBIS. We've covered the business management and financials. Now let's get into Chapter 4, market sentiment. How's the market actually feeling about Nebius? Well, as that initial price roller coaster suggested, it's really mixed and pretty dynamic. Definitely fits that high growth, high-risk AI profile.
We saw that big pop above $50 after they relisted.
Yeah, huge initial enthusiasm.
Yeah.
The market clearly liked the pure-play AI infrastructure story spinning out of Yandex.
But then the drop, over 50%, what cooled things off?
Probably a few things hitting at once, some natural profit-taking after such a quick run-up, then reality setting in about the lack of current profits, the cash burn.
And that sequential revenue slowdown we talked about.
That likely played a role too. Plus, just broader market jitters about high-growth tech valuations, especially in AI. People started asking harder questions about the path to profitability and whether the valuation made sense now.
So what are the analysts saying? Are they buying the long-term story?
Generally, yes, the long-term outlook seems positive among analysts, but there's definitely near-term caution. The most telling thing is the huge range in their price targets.
How wide a range?
You might see targets down to the $20, but others still up in the $40s, maybe even $50 or more. There's just no strong consensus.
Which reflects the uncertainty, I guess.
Exactly. The average target is probably still above where the stock was trading in late April, suggesting some upside potential, but that lack of agreement is significant. They're likely debating things like how quickly Nebius can reach profitability, can they actually execute this massive global build-out, and can they really compete with the giants like AWS and Azure.
What about recent news? What's moved the needle lately?
It's been a mix. Positive news would be things like progress reports on the data centers, confirmation they secured the Blackwell GPUs, that big $700 million funding round, and the strong 2025 revenue guidance. That stuff helps the bull case.
And the negative?
The Q4 earnings report, while showing great year-over-year growth, probably raised eyebrows with that sequential slowdown and the continued big losses. And any negative sentiment shift in the broader AI sector or tech market tends to drag down names like Nebius too.
What about things like short interest? Are lots of people betting against it?
The analysis didn't give a specific number for late April, but you'd expect a stock with this kind of profile, high growth, unprofitable, debated valuation, to attract a decent amount of short interest. High options activity and volatility would also be typical, showing active speculation and hedging.
Okay, so a market that's intrigued, maybe even excited long-term, but definitely nervous about the near-term execution and path to profit. Let's move to Chapter 5. Ownership structure. Who actually owns Nebius?
Well, on the institutional side, ownership was likely still building up after the relisting. You'd expect to see index funds, growth funds, tech specialists, maybe sovereign wealth funds gradually taking positions.
And NVIDIA's investment is notable there.
Absolutely. NVIDIA putting their own money in is a strong signal. But remember, the detailed 13F filings showing exactly who owns what always come out with a time lag.
And the insiders. We already hit the big one, Veloz's control.
Yeah, that's the dominant factor. The Astar Trust, controlled by Veloz, holds all the Class B supervoting shares. So around 13% economic ownership translates to over 55% voting control.
Any other significant insider holding?
Other directors and key employees hold shares too, but the trust's holding overshadows everything else. Watching for any insider buying or selling in SEC filings is always interesting, though there might have been lockup periods after the relisting.
So ownership is highly concentrated due to that dual-class structure. What does that mean for governance?
It means governance is effectively controlled by the Astar Trust. Public Class A, shareholders have very little real power over major decisions. It raises those standard governance concerns about accountability and alignment of interests.
Even though it might allow for long-term focus?
That's the argument for it, yes. But it comes at the cost of shareholder democracy. And being a Dutch company listed as a foreign private issuer on NASDAQ might mean they have exemptions from certain U.S. governance rules, too. It's a key risk factor for governance-focused investors.
Definitely something to be aware of. Okay, let's tackle Chapter 6, risk assessment and the SWOT analysis. What are Nebius's core strengths?
The analysis points to several. Experienced leadership under Veloz, deep tech talent pool from the Yandex heritage, their clear, dedicated focus on the booming AI infrastructure market, a strong balance sheet right now, lots of cash, no debt, that key NVIDIA partnership, and early access to Blackwell tech, their own proprietary full-stack tech, which could offer cost or performance benefits, and those existing subsidiary businesses like Toloka and TripleTen provide some diversification.
Sounds pretty good. What about the weaknesses? Where are they vulnerable?
The big one is the lack of profitability, those big losses and cash burn. Their operating history as Nebius is short, making trends hard to analyze. Huge execution risk with this massive simultaneous global build-out. Maybe that sequential slowdown was a hint of challenges there. Brand recognition is still low compared to the cloud giants, reliance on key people like Veloz. And as we've hammered home, that dual-class share structure is a major governance weakness for many.
Okay, weaknesses identified. What are the big opportunities they could seize?
The biggest is just the sheer size and explosive growth of the AI infrastructure market itself. Demand is soaring. They have a chance to carve out a niche by offering better performance or maybe lower costs or specialized services just for AI. Geographic focus could be key too, maybe leveraging their European base. Expanding partnerships beyond NVIDIA is possible. And maybe, down the line, they could even become an acquisition target for a bigger player wanting their specialized AI capabilities.
It's a classic David versus Goliath setup against the hyperscalers.
Kind of, yeah. They're betting specialization wins.
Makes sense. But what are the threats lurking out there? What could derail them?
Competition is brutal. AWS, Azure, Google Cloud, they have scale, resources, customer relationships. Plus other specialized AI cloud startups are popping up. Intense competition means pricing pressure is a real risk.
Technology changes fast, too.
It's exactly. Keeping up with AI hardware requires constant, massive investment. Their reliance on NVIDIA is also a risk. What if that relationship sours or NVIDIA faces its own supply issues? Then there's regulation. The EU AI Act, GDPR, data privacy rules add complexity and cost. Economic downturns hitting IT spend, supply chain disruptions for GPUs, even energy costs for these power-hungry data centers. Lots of external factors.
The analysis mentioned potential U.S. tariffs in 2025. How might that impact Nebius?
That would likely be negative for them, especially with their big U.S. build-outs planned in Kansas City and New Jersey. Tariffs on imported GPUs or other hardware would directly increase their costs, potentially cause delays, and maybe put them at a cost disadvantage versus competitors in the U.S. market. It could also indirectly dampen demand if it slows the U.S. economy. So, yeah, tariffs would be an unwelcome hurdle for their U.S. expansion.
Okay, we've covered a lot of ground: the business, the money, the market, the risks. Let's bring it all together in Chapter 7. Conclusion. What are the main takeaways here?
I think it boils down to this. Nebius Group is a company with a potentially very strong position in a massive growth market. They've got the technical chops, experienced leadership, and a clear focus. But
There's always a but.
yeah, the but is significant challenges. Achieving profitability is hurdle number one. Executing this incredibly ambitious global build-out without major hiccups is hurdle number two. Fending off intense competition is hurdle number three. And that governance structure is a persistent question mark for many investors.
So if you're looking at this through a traditional value investing lens,
Through that lens, looking for current profits, established moats, a margin of safety, Nebius just doesn't look attractive right now. The valuation is high, profits are non-existent, the moat is still being built. It's really a bet on future potential, not current demonstrable value. Highly speculative at this stage.
a growth story, not a value story yet.
Exactly. The price seems to assume a lot of future success is already guaranteed.
Which leads to a really interesting final thought for you, our listener. With AI transforming everything and billions pouring into infrastructure like this, is that traditional value framework always the best way to spot the future winners? Or do we need different tools, different metrics maybe, to evaluate these kinds of hyper-growth tech companies in totally new markets?
That's the multi-billion-dollar question, isn't it?
Yeah.
How do you value potential disruption accurately?
Maybe something we can explore more in a future deep dive, looking at alternative valuation methods for companies just like this. Now, the detailed analysis we've been working through today comes from START Research.
Right.
If you want more in-depth reports and analysis like this one to help you make sense of the market, definitely subscribe to the Stock Analytics AI YouTube channel.
Lots of good stuff there.
And finally, the important reminder. This conversation was based on publicly available information and our analysis of it. It is absolutely not financial advice. Always do your own research before making any investment decisions.
And remember, this analysis incorporated AI and various research methods. Please consider that context.
Thanks so much for joining us for this deep dive into Nebius Group.